Warren Buffett, one of the most successful investors of all time, has spent decades studying the markets and learning from both his successes and mistakes. While he's known for his incredible investment acumen, Buffett also emphasizes the importance of learning from errors, both his own and those of others. Here's a look at 10 common mistakes that every investor, regardless of experience, should be aware of, according to Buffett's philosophy. The first mistake many investors make is focusing too much on short-term results. Buffett has consistently advocated for a long-term investment approach. Chasing quick gains can lead to impulsive decisions, often resulting in buying high and selling low. Instead, Buffett advises looking at the bigger picture and investing in businesses with strong fundamentals that can grow over time. Another common error is not doing enough research. Buffett spends hours reading and studying before making any investment decision. Jumping into an investment without fully understanding the business, its market, and its competition is a recipe for disaster. Thorough research is essential to making informed decisions and avoiding costly mistakes. Overconfidence is a dangerous pitfall that Buffett warns against. It's easy to become overconfident, especially after a few successful investments, but this can lead to risky bets and poor judgment. Buffett advises maintaining humility and recognizing that even the best investors make mistakes. Acknowledge that you don't know everything and stay open to learning. Investors often fall into the trap of following the crowd. When a stock becomes popular, it's tempting to jump on the bandwagon. However, Buffett's contrarian approach, being fearful when others are greedy, and greedy when others are fearful, can help you avoid overpriced investments. Just because everyone else is buying doesn't mean it's a good idea. Ignoring the fundamentals of a company is another frequent mistake. Buffett is a staunch believer in investing in companies with strong financials, solid management, and a competitive edge. Investing based on hype or trends without considering the underlying fundamentals can lead to significant losses. Not diversifying enough is a mistake that many investors make, particularly when they become too attached to a single stock or industry. While Buffett's portfolio is relatively concentrated compared to others, he still spreads his investments across different sectors. Diversification helps reduce risk and protect your portfolio from market volatility. Timing the market is something Buffett advises against. Trying to predict when the market will go up or down is nearly impossible, and attempting to do so can lead to missed opportunities. Instead, Buffett suggests focusing on the quality of your investments and holding them for the long term, regardless of market fluctuations. Letting emotions drive decisions is a major mistake that Buffett has seen countless times. Fear and greed are powerful emotions that can cloud judgment and lead to poor decisions. Sticking to a rational, disciplined approach is key to avoiding emotionally driven mistakes. Neglecting the importance of cash flow is another common error. Buffett places a strong emphasis on investing in companies with reliable and growing cash flows. Cash flow is the lifeblood of a business, and companies that generate strong cash flow are more likely to withstand economic downturns and continue growing. Finally, one of the biggest mistakes investors make is not learning from their mistakes. Buffett is known for his ability to reflect on his errors and learn from them. Every mistake is an opportunity to improve your investment strategy and avoid making the same error in the future. Embrace your mistakes as part of the learning process and use them to become a better investor. These 10 mistakes serve as valuable lessons for any investor looking to improve their strategy and build wealth over the long term. By understanding and avoiding these common pitfalls, you can align your approach more closely with Buffett's time-tested investment principles. Another common pitfall that Warren Buffett highlights is overcomplicating your investment strategy. Many investors, particularly those new to the market, believe that successful investing requires complex strategies and constant tinkering with their portfolios. However, Buffett's approach is the opposite. He emphasizes simplicity. He believes in buying businesses that are easy to understand and that have straightforward, predictable paths to profitability. Overcomplicating your strategy can lead to confusion, increased costs, and, ultimately, lower returns. Buffett's success lies in his ability to keep things simple and focus on the basics. Underestimating the importance of management is another mistake investors often make. Buffett pays close attention to the quality of a company's leadership, because great management can turn a good company into an exceptional one. Conversely, poor management can drive even a well-positioned company into the ground. When evaluating potential investments, Buffett looks for leaders who are honest, have a clear vision, and are capable of executing that vision effectively. Ignoring valuation is a mistake that can lead to overpaying for an investment, regardless of how promising the company may seem. Buffett is famous for saying, "Price is what you pay, value is what you get." This means that even the best company can be a bad investment if you pay too much for it. Buffett's strategy involves buying quality companies at a fair price, not just chasing growth at any cost. Understanding the intrinsic value of a company is crucial to making sound investment decisions. Failing to reinvest dividends is another often overlooked mistake. Reinvesting dividends can significantly boost your returns over time thanks to the power of compounding. Buffett is a big advocate of compounding returns, and by reinvesting your dividends, you allow your investments to grow more rapidly. This simple but powerful strategy can make a substantial difference in your portfolio's long-term performance. Ignoring the impact of taxes and fees on your investments is a mistake that can erode your returns over time. Buffett is very mindful of minimizing costs, including taxes and fees, to maximize net returns. High fees, frequent trading, and not taking advantage of tax-efficient accounts can all eat into your profits. Being conscious of these factors and managing your investments with cost efficiency in mind is critical for long-term success. Lack of patience is a mistake that Buffett often warns against. He believes that time is one of the most powerful tools in an investor's arsenal. The ability to wait for the right opportunity and hold investments for the long term is what sets successful investors apart. Impatience can lead to rash decisions, such as selling a stock too early or buying into a trend too late. Buffett's strategy involves waiting for the right opportunities and letting his investments compound over time, rather than constantly chasing short-term gains. Finally, ignoring the bigger economic picture is a mistake that can leave investors blindsided by major market shifts. While Buffett doesn't base his investment decisions on macroeconomic predictions, he does stay informed about the broader economic environment. Understanding factors like interest rates, inflation, and global economic trends can help investors make more informed decisions and anticipate potential risks. Being aware of the broader context can help you avoid pitfalls and position your portfolio for long-term success. By learning from these common mistakes and applying Buffett's timeless principles, you can improve your investment strategy and increase your chances of achieving financial success. Remember, successful investing isn't about making quick profits, it's about building wealth steadily over time through careful, informed decisions. Warren Buffett's legendary status in the world of investing is built on his unwavering principles and his ability to avoid common pitfalls that many investors fall into. But what truly sets him apart is his focus on the long term. Unlike many who chase quick profits, Buffett's strategy revolves around patience and the belief that time in the market is more important than timing the market. This philosophy has allowed him to accumulate immense wealth by holding onto quality investments for decades. One of Buffett's key strategies is his emphasis on investing in businesses, not stocks. He approaches every investment as if he's buying the entire company, not just shares. This mindset shifts the focus from short-term stock price movements to the overall health and potential of the business. By doing so, Buffett ensures that he's investing in companies with strong fundamentals, sound management, and a durable competitive advantage. This approach has led to his success in identifying businesses that continue to grow and generate returns over the long term. Another essential aspect of Buffett's approach is his reluctance to follow the crowd. He often says, "Be fearful when others are greedy, and greedy when others are fearful." This contrarian mindset has helped him avoid market bubbles and make significant investments during times of market downturns. While many investors panic and sell during market dips, Buffett sees these moments as opportunities to buy quality companies at a discount. This discipline in sticking to his principles, even when it goes against the prevailing market sentiment, has been a cornerstone of his success. Buffett also places a strong emphasis on maintaining a margin of safety in his investments. This concept, which he adopted from his mentor Benjamin Graham, involves buying stocks at a price significantly below their intrinsic value. By doing so, Buffett ensures that even if the company doesn't perform as expected, there's still a cushion that protects his investment from substantial losses. This risk-averse approach has helped him minimize losses and maximize gains, contributing to his long-term success. Another lesson from Buffett is the importance of continuous learning. Even after decades of investing, Buffett still spends a significant portion of his day reading and learning about new industries, businesses, and economic trends. This commitment to self-improvement keeps him informed and ready to adapt to changing market conditions. It's a reminder that successful investing requires ongoing education and a willingness to evolve with the times. Buffett's success is also deeply rooted in his ability to stay disciplined. He doesn't let emotions dictate his investment decisions, and he's willing to wait for the right opportunities rather than chasing every new trend. This discipline extends to his financial habits as well, such as living frugally and focusing on accumulating wealth over time rather than spending it. His lifestyle choices reflect his belief that long-term financial security is built on a foundation of careful planning, disciplined investing, and smart decision-making. Lastly, Buffett's philosophy is underpinned by his commitment to integrity and ethical business practices. He believes that honesty, transparency, and trustworthiness are crucial components of a successful business. This ethical approach not only guides his own investments but also influences the companies he chooses to invest in. Buffett's reputation for integrity has earned him the trust of investors and business leaders worldwide, further enhancing his ability to make sound investments and build lasting wealth. By embracing these principles, you too can approach investing with the wisdom and discipline that have made Warren Buffett one of the most successful investors of all time. Understanding Warren Buffett's investing strategies provides a blueprint for success that extends beyond mere financial gain. One of the most compelling aspects of his approach is his commitment to patience and discipline. Buffett's mantra of "it's better to buy a wonderful company at a fair price than a fair company at a wonderful price" highlights the importance of quality over quantity. This approach encourages investors to focus on long-term growth rather than short-term fluctuations. Buffett's investment philosophy is deeply rooted in the idea of value investing. He looks for companies that are undervalued by the market but have strong potential for growth. This involves a meticulous analysis of a company's financial health, including its earnings, debt levels, and overall management. By identifying businesses with a strong foundation, Buffett ensures that his investments are not just speculative but are backed by solid data and analysis. A critical lesson from Buffett is his avoidance of debt. He advises against over-leveraging, believing that debt can be a double-edged sword that amplifies risks. Instead, Buffett advocates for building wealth gradually through investments that compound over time. This conservative approach has helped him avoid the pitfalls that many investors face when markets become volatile. Another key to Buffett's success is his focus on dividends. He prefers companies that not only grow but also return value to shareholders through consistent dividend payments. This provides a steady stream of income that can be reinvested, further compounding the growth of his portfolio. For investors, this underscores the importance of choosing stocks that offer reliable returns over the long haul. Buffett's ability to stay the course during market downturns is another critical aspect of his strategy. While many investors panic and sell off their holdings when the market dips, Buffett remains steadfast, often buying more of the stocks he believes in. His famous saying, "The stock market is a device for transferring money from the impatient to the patient," encapsulates his belief in the power of long-term investing. Moreover, Buffett's practice of reinvesting profits back into his business and investments has been a significant driver of his wealth. By continually reinvesting, he maximizes the compounding effect, allowing his wealth to grow exponentially over time. This strategy is a reminder that the path to wealth is often a marathon, not a sprint, and that patience and reinvestment are crucial components of financial success. Finally, Buffett's emphasis on living below your means is a fundamental principle that can benefit any investor. Despite his immense wealth, Buffett is known for his frugality and modest lifestyle. This not only allows him to save and invest more but also ensures that he remains focused on long-term financial goals rather than short-term gratification. By internalizing these principles, you can adopt a mindset that prioritizes long-term growth, disciplined investing, and financial stability. These are the cornerstones of Warren Buffett's success and can serve as a guide for anyone looking to achieve financial independence and prosperity. If these insights resonate with you, make sure to subscribe to our channel and like this video for more valuable tips and strategies that will help you on your financial journey.